I wish I knew this when I started my investing journey, guys. It took me almost 5 years into my investing journey to understand these investing safety tips. Therefore, I want to share these tips to all the investors out there so that you can become a better investor, and I hope it adds value to you. The first step is beware of the financial advisors. So, almost 90% of financial advisors around the globe are just brokers. Yeah, it may sound bad, but they are paid to sell financial products to customers like you and me in return for a fee. And the problem is they work in a system that's beyond their control. So let me give you my story. I was working with a financial advisor who was dealing my employer's pension plan. And at some point, I was leaving my employer and I had a discussion with this advisor for my option for keeping the fund within their pension to another low cost fund, or move to another financial institution and give some recommendations. So this advisor was mostly recommending me a fund with higher fee within the same pension fund. So I told this advisor at that point, let me review and get back. And after a while, I called him back and I told him that I have decided to transfer to another financial institution, to a low cost fund. And I asked the transfer process. And guess what? This advisor right away said he does not know the process and I should talk to the toll-free number and get going. You can clearly see he doesn't have that fiduciary responsibility to taking care of you. So how do you know what is the fiduciary? How can you identify a good financial advisor? A good financial advisor is one that can help you to identify what is best for you. The best can be a low cost fund which can give you a decent return, right? So he can help you to rebalance your portfolio, which can yield better investment outcome. He can help you with good asset allocation. He can help you to do some behavioral coaching, when to take the money, when not to take that money. But it's very difficult for you to find these type of good financial advisors. So that's why I say 90% of the financial advisor out there are not really reliable. So please keep this in mind. So whenever you go to any financial institution, be a bank, you would always find that they want to sell their product, not necessarily to increase your return. So in my view, at least, you can create a lot of wealth by doing it yourself, and you alone are the most capable person alive to manage your money. Yes, if you find that best advisor, you're good. But otherwise, in my view, you are the only one who can manage your money to the best of your ability. Okay, the second safety investing tip is avoid losses. As Warren Buffett says, the first rule of investing is don't lose money, and the second rule is never forget the first rule. I too believe that avoiding loss should be the primary goal of every investor. But now this doesn't mean that you should never incur loss, because that's unavoidable. Anytime when you start investing, you would always incur some sort of a loss. But rather, what it really means by when we say don't lose money is over several years, an investment portfolio should not be exposed to appreciable loss of principal. That's what I mean. Okay, the third safety investment tip is investment requires a mindset. Yes. So in order for you to be successful in investing, you need to have an appropriate mindset. First of all, think that investing is a serious business. It's not an entertainment, guys. If you participate in the financial market, it is crucial to understand that you do so as an investor, not as a speculator, and to be certain that you understand that difference. Because a lot of people think and follow this get rich quickly scheme. A few years, the crypto market went up high, lot of coins came up, and people followed and lost money. Okay, the next safety tips on investing is emotions play a havoc in investing. So, unsuccessful investors are dominated by emotions. It's not just unsuccessful, you and me, all of us are have some sort of an emotion, biases, right? So, and the market fluctuates every day, day in, day out. So, as an investor, you should approach these fluctuating market without any emotions, because the investing is a business. In business there is no emotions whatsoever. So, but you know that we all act responsibly and deliberately most of the time. But when it comes to investing, we go berserk. It may take, for us many months or even years of hard works and disciplined saving to accumulate that money. But only a few minutes to invest because you just heard that stock from your friend or you read about it, and that's completely nonsense, right? The fifth safety tip on investing is most investors can't predict the short-term macro event that lies ahead and how market will behave. So guys, so please avoid making all these prediction and following all these noises because it really doesn't matter for people like you and me. For example, we talk about how bad will inflation get? How much will the Fed raise the interest rate to fight it? Will those increases cause a recession? How bad and for how long? The bottom line is all these things relate to short term, and this is what I know. Most investors can't do a superior job of predicting short term phenomenon like this. Thus, you shouldn't put much stock in opinion on these subjects. The sixth safety investment tip is reasonable and consistent returns are always greater than spectacular and volatile returns. A corollary to this importance of compounding is that it is very difficult to recover from even one large loss, right? Which could literally destroy all at once the beneficial effect of many years of investment success. So, for example, in other words, think about this: an investor is more likely to do well by achieving consistently good returns with limited downside risk than by achieving a volatile and sometimes even a spectacular gains but with considerable risk of principal. The seventh safety investment tip is prepare for the worst. Not preparing for the worst is one of the major causes for investor losing their money, hard-earned money. Because think about this, no one can precisely predict the valuation of the securities or the asset that you're buying, right? And not only that, you don't know how the future is going to unfold on these investments. And finally, we as a human, we are prone to errors. Therefore, it is important that we have margin of safety when you make any investment, because we cannot be we shouldn't have the biases thinking that future will be very much optimistic. We should account for all these uncertainty and buy the asset with some sort of a bargain. That is the key. For example, US stock market has written an annual average of 6.8% after inflation since 1870. Now, when we invest in a simple US index fund seeking this 6.8% return, I would expect that the return to be less than 6.8%, and by doing that, I'm accounting for the margin of safety by compensating that difference by saving more and investing more. So the eighth safety investing tip is focus on the process, not on the outcome. Many investors mistakenly establish an investment goal of achieving a specific rate of return. But setting a goal and unfortunately does not make the return achievable. So, indeed, no matter what the goal is, it may be out of reach. So, for example, you may set a target, investment return target of 15% a year, but it does not tell you how you are going to achieve it. Investment returns are not direct function of how long or hard you work or how much you wish to earn. So, investor cannot decide to think harder or put in overtime in order to achieve a higher return. Rather, you should be focusing on how consistently and disciplined approach that you can make on investing, and over the time you would see the result, which is basically the returns. The final safety tip on investing is minimize the mistake due to your behavioral biases. Because successful investing is 1% about what you know and what you buy, and 99% about how you behave. But then as a human, we are not wired to behave well, especially in the area of uncertainty, like investing, right? We suffer from innumerable cognitive biases. Interestingly, how much ever we read about these biases, how they fool our brains is surprising, right? We still fall for them, right? And so the idea of dealing with these biases is not to try and eliminate them, guys, but to try and minimize the mistake caused by them. So it comes by the practice and sheer experience and following the process.